20% of the world's oil supply passes through a waterway that is less than 21 miles wide at its narrowest point, the Strait of Hormuz, a choke point between Iran and Oman that connects the Persian Gulf to the Gulf of Oman and the Arabian Sea. And as of February 28, 2026, with U.S. and Israeli strikes on Iran active and Iranian retaliation underway, that choke point is now at the center of the most critical energy security crisis since the 1973 oil embargo. Oil is trading above $70 per barrel. Analysts are modeling scenarios where sustained conflict pushes it to $80, $90, or even $100. And what almost nobody is connecting is what $100 oil does to silver mining economics. Let me show you why the Strait of Hormuz risk is not just an oil story. It is a structural silver supply story that makes every bull case target we have been discussing not just possible, but increasingly inevitable. Start with the basic facts about Hormuz because the geography is what creates the vulnerability. The Strait of Hormuz is the world's most important oil choke point. According to the U.S. Energy Information Administration, approximately 21 million barrels of crude oil and petroleum products pass through it daily. That represents roughly 21% of global petroleum liquids consumption. About 85% of crude oil that transits the strait goes to Asian markets, with China, India, Japan, and South Korea as the largest destinations. There is no alternative route that can handle anything close to that volume. Some oil can be rerouted through pipelines that bypass the strait, but total pipeline capacity is only about 6 million barrels per day. If Hormuz is fully closed, approximately 15 million barrels per day have no viable alternative route to market. Iran has threatened to close the strait multiple times over the past 4 decades. During the Iran-Iraq War in the 1980s, both countries attacked oil tankers in what became known as the Tanker War. In 2008, 2011, 2012, and 2018, Iranian officials threatened closure in response to sanctions or military tensions. And just 2 weeks ago, on February 17, 2026, Iran closed the strait for military drills. Ships were ordered to stay clear for 48 hours, while the Iranian Revolutionary Guard conducted exercises involving missiles, drones, and fast attack boats. That closure was temporary and announced in advance. A wartime closure would be neither. Here is what makes the current situation materially different from previous threats. In past escalations, Iran was threatening closure as deterrence. The threat itself was the weapon. Actually closing Hormuz would have triggered immediate U.S. military response to reopen it, which Iran knew and which is why the threat was more valuable than execution. But now, with U.S. and Israeli strikes actively hitting Iranian territory, Iran is already in a shooting war. The deterrence value of threatening closure is gone. The question is no longer, will Iran close Hormuz to deter attack? The question is, will Iran close Hormuz as retaliation for an attack that is already happening? And a senior Iranian official told Al Jazeera that all American and Israeli assets and interests in the Middle East have become legitimate targets with no red lines. Oil infrastructure and shipping lanes clearly fall within that scope. Now let me show you what oil price scenarios look like depending on how this plays out. In a limited conflict scenario where strikes last a few days and Iran retaliates but does not attempt sustained Hormuz closure, oil markets are pricing a risk premium of $5 to $10 per barrel. That puts WTI in the $75 to $80 range and Brent in the $80 to $85 range. That premium assumes shipping continues, insurance costs rise modestly, and traffic through Hormuz slows but does not stop. In an extended conflict scenario where fighting lasts weeks and Iran conducts sporadic attacks on tankers or threatens mining operations in the shipping lanes, oil moves into the $85 to $100 range as insurance costs spike, some tanker operators refuse to transit, and buyers build precautionary inventories. In a full closure scenario where Iran uses mines, missiles, or fast attack boats to effectively block traffic for days or weeks, oil spikes above $100 and potentially significantly higher depending on duration. Strategic petroleum reserves get released. Alternative supply routes get activated. But 15 million barrels per day cannot be replaced quickly. Prices would reflect genuine scarcity. The International Energy Agency has modeled a complete 6-month closure of Hormuz. Their scenario shows oil prices spiking initially to $140 per barrel before moderating as demand destruction kicks in, alternatives ramp up, and strategic reserves are deployed. Even after moderation, prices in that scenario stay elevated above $100 for months. That is the catastrophic scenario. But even the limited and extended scenarios, which are far more probable, put oil in the range where silver mining economics change fundamentally. Here's the mechanism that connects oil prices to silver supply. Silver mining is energy intensive. You have to move massive amounts of ore, crush it, process it chemically, and refine it into pure metal. All of that requires energy. Diesel fuel for trucks and excavation equipment, electricity for processing plants, natural gas for heating and chemical reactions. When oil is at $50 per barrel, those energy costs are manageable. When oil is at $100, energy costs double. For a mine that was marginally profitable at $50 oil, doubling energy costs makes it uneconomic. The mine either shuts down, reduces production, or requires a higher silver price to maintain profitability. Silver mine production globally is approximately 820 million ounces per year, according to the Silver Institute. But not all of that production comes from mines where silver is the primary metal. About 70% of silver production is a byproduct of copper, lead, and zinc mining. Only 30% comes from primary silver mines where silver is the main economic driver. That distinction matters because when oil prices rise, primary silver mines can partially offset the cost increase by raising their selling price for silver. But byproduct silver from copper or zinc mines does not respond to silver prices. Those mines are optimized for copper or zinc economics. Even if silver prices double, a copper mine is not going to increase production because the mine's profitability is driven by copper prices, not silver prices. What this means practically is that when oil goes to $100, the marginal primary silver mines that produce approximately 250 million ounces per year face a profitability crisis. Some percentage of that production, conservatively 10 to 20%, becomes uneconomic unless silver prices rise proportionally. If 50 million ounces of primary silver production goes offline because $100 oil makes it unprofitable, that supply disappears from the market. Global demand is approximately 1.12 billion ounces per year. Losing 50 million ounces is 4 to 5% of supply. The Silver Institute already confirmed a 67 million ounce structural deficit before accounting for any supply disruption from high oil prices. Add another 50 million ounce supply reduction and the deficit widens to 117 million ounces, nearly doubling the shortfall. Now let me show you what that widening deficit does to price. When demand exceeds supply, prices rise until either demand is destroyed or new supply is incentivized to come online. Demand destruction in silver is extremely difficult because most demand is industrial and inelastic. Solar panel manufacturers cannot build panels without silver. Electronics producers cannot build circuits without silver. Electric vehicle makers cannot build certain components without silver. That demand does not go away when prices rise. It gets passed through to consumers in the form of higher product prices. The solar panel costs more. The phone costs more. The car costs more. But the panel still gets built, the phone still gets manufactured, and the car still gets produced because consumers still buy them. New supply coming online takes 7 to 10 years. You have to discover the deposit, secure permits, build the mine infrastructure, and ramp to production. A discovery made in 2026 does not produce ounces until 2033 to 2036. That means the supply curve is locked for the rest of this decade, regardless of what prices do in 2026. All of the industrial demand growth from solar, EVs, and AI over the next 7 years has to be satisfied by existing production levels, which are already in deficit, minus whatever supply gets removed by $100 oil, making marginal mines uneconomic. That math does not balance at $90 per ounce. It probably does not balance at $150 per ounce. It might not balance until silver reaches levels that force genuine demand destruction, which would require silver becoming prohibitively expensive for industrial uses. And we are nowhere near that threshold yet. Here is the optimistic framing that I want you to take away from this. The Strait of Hormuz risk is not a temporary geopolitical event that creates a short-term premium and then disappears. It is a structural energy security issue that elevates oil prices for months or years, which in turn removes marginal silver supply from the market for months or years, which in turn forces silver prices structurally higher to incentivize new production and ration existing supply. This is not about war premium. This is about mining economics changing in a way that makes current silver prices unsustainably low relative to the cost of production. David Hunter's $180 silver target by Q2 sounded aggressive when oil was at $60. At $100 oil, it sounds conservative. Rashad Hajiev's $250 target, if the gold-silver ratio compresses to 30, sounded like a bull case outlier. At $100 oil with marginal supply offline, it sounds like the math that rebalances the market. Robert Kiyosaki's $500 target sounded like hype. At $100 oil sustained for years while industrial demand grows and supply cannot respond, it starts sounding like the endpoint of a supply-demand imbalance that has no other resolution. Let me give you the specific timeline and price scenarios I am watching. If oil stays in the $70 to $80 range, which is the current base case assuming limited conflict, mining costs increase modestly, but most production remains economic. Silver needs to rise to 100 to 120 to offset those cost increases and maintain mine profitability. If oil moves to $80 to $100, which is the extended conflict scenario, mining costs increase significantly and 10 to 15% of marginal primary silver production becomes uneconomic. Silver needs to rise to 120 to 150 to offset those cost increases and replace the lost supply with higher cost alternative sources. If oil spikes above $100 and sustains there, which is the full Hormuz closure scenario, mining costs double and 20 to 30% of marginal primary silver production shuts down. Silver needs to rise to 150 to 200 or higher to incentivize that production to restart and to ration existing supply across competing industrial uses. Those are not speculative price targets. Those are the prices required to balance supply and demand under different oil price scenarios. The market will discover those prices through trial and error. Silver will rise. Some demand will be rationed. Some supply will come back online. The price will find an equilibrium. But that equilibrium is materially higher than $91 under any scenario where oil sustains above $75 for an extended period. Here's the geopolitical overlay that makes this even more likely. Iran is not going to reopen Hormuz fully and immediately, even if strikes stop tomorrow. They have spent decades building the military capability to threaten that choke point. Fast attack boats, anti-ship missiles, mines, drones, all of that infrastructure exists specifically to give Iran leverage over global oil markets. In a post-strike environment, even if active combat ends, Iran will use the threat of Hormuz closure as ongoing leverage. Tanker traffic will be slower, insurance costs will stay elevated, some operators will avoid the route entirely. That means oil prices stay elevated above pre-war levels for months or potentially years until a new equilibrium is reached where Iran, the US, and regional powers find a stable deterrence balance. And during that entire period, elevated oil prices keep marginal silver mines uneconomic, keep supply constrained, and keep prices structurally supported. China's role also matters. China imports approximately 70% of its oil, much of it through Hormuz. If Hormuz closes or traffic is significantly disrupted, China faces an energy security crisis. Their response will be to increase strategic petroleum reserves, accelerate renewable energy deployment, and potentially tighten export controls on strategic materials, including silver, to ensure domestic supply for their own industrial use. We already covered China's silver export licensing system implemented January 1, 2026. If oil prices spike and China faces energy scarcity, those export controls tighten further. That removes even more supply from global markets and forces non-Chinese buyers to compete for a shrinking pool. The Shanghai premium at $9.38 is already reflecting some of this dynamic. Chinese buyers are paying 11% above COMEX prices for physical silver before oil spiked and before export controls tightened further. If oil goes to 100 and China restricts exports, that premium could widen to 15, 20, or even 25%. At a 25% premium over COMEX, Chinese buyers would be paying $114 for silver, while COMEX is at 91. That gap is unsustainable. Either COMEX rises to close the gap, or the gap persists, and COMEX becomes irrelevant as the global price benchmark. Both outcomes are bullish for physical silver holders. Let me also address the recycling argument, because bears will point out that higher silver prices incentivize more recycling, which increases supply. That is true, but insufficient to close the deficit. Silver recycling currently provides about 180 to 190 million ounces per year, roughly 20% of supply. The Silver Institute project's recycling could increase modestly to 200 to 210 million ounces if prices rise significantly. But even at the high end, recycling only offsets a small fraction of the structural deficit. You cannot recycle silver that is locked in solar panels installed on rooftops. Those panels have a 25 to 30-year lifespan, and the silver is not economically recoverable until the panel is decommissioned decades from now. You cannot recycle silver in electronics that are still in use. The average smartphone or computer has a 5 to 10-year useful life. The silver is only available for recycling after the device is discarded. Recycling helps at the margin. It does not solve the structural deficit. Here is my final optimistic take connecting all of this to what we have been tracking for weeks. COMEX. First notice day stress is real. March deliveries are elevated. Shanghai premium at $9.38. Confirmed physical demand exceeds paper supply. Now add Strait of Hormuz, risk, and $100 oil. Industrial users who were already hedging through COMEX futures see oil spiking and supply chains at risk. They accelerate hedging. They increase delivery demands. They replicate Samsung's direct mining deals. That compounds COMEX stress. The exchange is forced to raid SLV, deploy margin hikes, or cash settle. Physical premiums widen further. The gap between paper and physical becomes undeniable. And silver reprices structurally higher not because of speculation, but because the cost to produce it rose, the supply available to markets fell, and demand remained constant or grew. Stay positioned. Watch oil prices, watch COMEX deliveries, watch Shanghai Premium. All three are telling the same story. Physical silver is undervalued at current prices. The Strait of Hormuz risk makes that undervaluation more severe, not less. And the next 60 to 90 days will prove that thesis as markets discover what silver actually costs when energy is expensive, supply is constrained, and demand cannot be rationed. This is the structural shift that validates every bull case we have been building.